Hey everybody, it's Rob Campbell, the mortgage broker. As you have probably already heard, the Bank of Canada has indeed increased the overnight lending rate. Um, Not really a shock at this point because of how inflation has been tracking. And over the last 2 years, we've had just at a quarter of a point above zero, a low overnight lending rate because of the pandemic, as we saw that rate kind of come down at the beginning of the pandemic. And now the Bank of Canada has announced this morning that that rate has gone up. And I just wanted to talk to you about what that means for people who have variable rate mortgages and home equity lines of credit. Okay. And personal lines of credit, really, but that's not tied to the mortgage industry. But well, that can be incorporated into this discussion as well. If you have a fixed rate mortgage already right now, this news means absolutely nothing to you. Your fixed rate is set for the term that you have, and it doesn't really concern you that the overnight lending rate is being increased. If you have a variable rate mortgage, however, this applies to you. And if you have a home equity line of credit, we'll talk about home equity lines of credit first, and then I'll talk about what that means for a variable rate mortgage and what that payment's going to look like. So if you have a home equity line of credit, which is of course a line of credit that's tied to your mortgage and your home, that rate will have also gone up this morning. And your financial institutions, depending on who you're with, will relay that to you in the next statement. Remember and keep in mind that a home equity line of credit is not created the same as an amortized mortgage, whereas a home equity line of credit is only calculating interest on a simple daily interest calculation. It's the best interest calculation that you could ever have. It's not compounding. And then it issues that that accrued interest into your monthly statement at the end of your 30 or 31 days billing cycle. So what that means to you is if your current home equity line of credit rate, went from 2.95 and it increased a quarter of a point this morning, on your next statement, you're going to see that reflected in the bottom of your statement. But those payments won't really be a huge amount. I'll actually do some quick math here as I get my trusty calculator up in front of me. On $100,000, if the home equity line of credit, if that increased by a quarter of a point, you're looking at approximately $250 a year in interest that has gone up. Not a huge amount. If you divide that over 365 days, again, if you've maxed out that $100,000 home equity line of credit, that's purely on the balance, not the limit, but on the balance. If you've maxed out that $100,000 line of credit at a $100,000 balance, and that's gone up a quarter of a point, you're only spending $250 a year more. On a daily basis, that's 68 cents of interest per day that it's going to increase. So not a whole hill of beans. Again, this cascades down if your home equity line of credit balance is lower. Okay, if it's 50,000 or 20,000, it's gonna be reflective of whatever your balance is at that time. So now onto the variable rate mortgages, and I know I'm going to get a lot of these calls, and that's okay. I'm actually going to drop a link to book a 15-minute call in my calendar, so maybe we can talk about your particular scenario if you have a variable rate mortgage. If you have a variable rate mortgage, your payments are likely going to increase. Not likely going to increase, they are going to increase, but they're going to increase reflective of whatever your mortgage balance is or was at the time of that rate increase. So I'm going to use some really, really basic numbers here, and it is specific on which lender you have, which product you have, if it's an insurable or a non-insurable variable rate mortgage. And again, that's why I want to drop that 15-minute link into the email here to book that phone call with me. But if you have a variable rate mortgage and the rate has increased by 0.25% or 25 basis points this morning, on $100,000 balance using a 1.45% variable rate that you would have had. So that's a pretty easy calculation. That's prime minus one for some of you that have that prime minus one variable rate mortgage out there. Your mortgage payment, if it was off of a 25-year amortization, your mortgage payment would have been $397.39. Okay, so we're using a $100,000 variable rate mortgage balance amortized over 25 years at 1.45%. So I'm just trying to paint the picture here. And if your balance is 2 or 3 or 350 or 450, then you can roughly use a multiple of this to figure this out. Again, I urge you to book a 15-minute call so we can rough these numbers out, work these numbers out over the phone for your particular lender. I digress. You go from $397.39 to approximately $409.12. So with that 25 basis point increase, you're looking at an approximate increase of your monthly payment of around $11.75 per 100,000. Okay, so about $12 per 100,000. Okay, and again, this is based off of an original amortization of 25 years. For every 100,000, it goes up about $11.75, or let's just call it $12 a month. Okay, so if you have a $200,000 mortgage balance, or at origination, I'm sorry, if your mortgage was $200,000 at origination, it's going up approximately $24 to $25 a month. Okay, so the reason I'm working out these basic numbers is to calm a lot of people down. If you're feeling really stressed out about these rate increases by the Bank of Canada. Now let's talk about if you were to convert that variable rate mortgage into a fixed rate mortgage, because I get a lot of emails and calls saying, Rob, it's just making me so nervous. The news is talking about prime lending rate going up 6 times or 8 times this year. What does that look like? Well, we have to understand that there's a lot of uncertainty in the world right now, one of which is obviously a war that's going on in Europe, which is tragic, but it's a reality. And this can disturb markets, not that to take away from loss of life and destruction that's happening. It's terrible stuff that's happening. But if we just keep it to the intention of this video for the numbers, the markets are, what we're actually seeing are fixed rates coming back down. Now, fixed rates, if you want to convert your variable rate mortgage to a fixed rate mortgage, there's something that you have to understand. For the most part, if you do that today, if you call your lender today and try to fix that in, you're likely looking at about a 1.5% increase right away into a fixed rate mortgage. Okay, because variable rate right now is around 1.5% for most of you that have a variable rate mortgage. You're going to be locking it into an approximation of around 3%. That's where fixed rates are today. So what does that look like for a payment increase? Well, if you took that $100,000 mortgage that you got a year ago, let's say, and you've worked it down to a balance of around 96.6. Again, I'm using really basic numbers here. Book a call with me to go over your specific numbers. But if you got your mortgage a year ago at 25-year amortization, and now you're at a 24-year remaining amortization, and you want to lock in your mortgage to a fixed rate, your new fixed rate mortgage is going to be around the 3% mark. And it's actually going to be amortized over a 24-year amortization for the most part. Okay, depends on lender, depends on product. But for the most part, you're going to be locking in at the remaining amortization. So what does that look like on a $100,000 balance from last year to today? Well, your payment's going to go from around $397.39 up to $470.27. So overnight, if you try to lock that into a fixed rate, you're going to see an increase to your mortgage payment per month of about $73 a month per $100,000 of your origination mortgage. So if you got a $500,000 mortgage last year on a variable rate mortgage and you decide to lock it in today, if we do that times 5, you're looking at immediately an approximate increase of your monthly payment of around $360 to $365 a month. Okay, so instead of the Instead of a $12 per month increase per 100,000, you could be looking at a $72 increase per month if you locked it in. Okay, so a huge gap in what those fixed rates and variable rates are doing right now. And actually, if I share my screen here, enough about you looking at this old battered face. If I share my screen here, I want to just share this screen over here. And we go to the 5-year bond. The Canada 5-year bond is, which is what the price, the fixed rate mortgages are priced off of. But if you look at this here and we just refresh it, obviously I'm filming this the day before on March the 1st in the afternoon, just to prepare for this email to go out. But you'll notice that this bond yield has started to drop. And if I change this to the last 3 months, you can see where this 5-year bond, and I'll explain what this means in a second, but you can see where this 5-year bond goes up and it kind of dips down and then spikes back up again, and then it really shoots down. That shot down there is purely because of what's happening in the world at this time. What this means to you is if you are considering locking that rate in, and you want to lock your mortgage into a fixed rate mortgage, again, everybody's scenario is different, right? How far along your term you are in your mortgage, what your plans are going forward, career change, another property, all of this stuff plays into this conversation. But if you are thinking about locking your rate in, you might just want to wait, because that 5-year bond is coming down. The yield is coming down more and more and more as the days go by with what's happening in Europe and the world. And in times of uncertainty, we do see that that number start to come down. What that means to you in simple terms is if you do want to lock in your mortgage, just wait it out. You know, it might be worth the $12 per month increase per 100,000 for you to just wait out this market to see where those fixed rates come down to over the next week, 2 weeks, month. We don't know. Really interesting to see how this is all going to play out. Again, not to make light of the situation in the world. If anybody watching this has family, I know we actually have family on my wife's side who has family members still in the Ukraine. You know, obviously that's a very troubling situation, but I digress. As far as variable rates going up, this is the first rate increase that we've seen in 2 years since the Bank of Canada plummeted that rate to help with COVID and closures and helping the economy chug along. I really think for the most part, and again, this is purely educational purposes only, everybody's situation is different. I think we all just need to pump the brakes and understand what the dollars are here if you do lock in versus if you stay on the variable and just ride out these rate increases. Another thing to keep note of is this: if you lock into a fixed rate mortgage because you're worried about the market and you lock in and you're okay with that $72 a month increase, then you, I'm sorry, lost my train of thought. What you're doing is you're opening up yourself to a penalty, a fixed rate mortgage penalty, should you break your 5-year fixed mortgage or your 4-year or your 3-year term, whatever you're going to take with your lender, depending on the product you're in. You're opening yourself up to a bigger penalty, because remember, a lot of the reason that a variable rate mortgage is so appealing is A, the really, really low rate, and B, you can break that variable rate mortgage on only 3 months interest penalty. That is a really low interest rate to pay a penalty on, and it's only 3 months interest. So a lot of just breathing and taking it easy as these rate increases start, because it's not the end of the world. A lot of the questions I get are, Rob, can this variable rate go from 1.5% to 10% tomorrow? No, it cannot. If the Bank of Canada even remotely moves, you know, a 50 basis point increase might send a real big shock through the market. And again, with uncertainty, what we have here is just waiting all of this out. So again, that's a little long-winded video, but I thought it would be timely to send out a video to everybody who has a mortgage with our brokerage, or just anybody in general who wants this question answered, is it the time to lock in? It really is case by case. For the most part, I think that the variable rate mortgage is still a great mortgage to have when we look at the uncertainty of the markets and try not to crush the economy as we come out of COVID and lockdowns and spending and all of this stuff. But there's a lot of uncertainty at this time. So we don't even know if 4 rate movements this year are even going to happen. Okay. Thank you for staying with me this long. If you have, again, please, I encourage you, book a 15-minute call. It costs you nothing. It might help ease your mind. It might answer some additional questions you might have. It might spur a conversation about maybe a move that you're thinking about doing, or downsizing or upsizing, or maybe taking on a home equity line of credit. Always here for you to book a call. Okay. Thank you so much for watching this. And I hope to hear from you soon. Take care, everybody.